Let's take a look at the D category trades. If we look at the chart on the left-hand side where the cycles exhibit the correct proportionality in terms of their amplitude and wavelength, then of course you will see the D category trade is happening here. It is a short trade and it occurs as price falls from the first peak of the cycle down towards the intermediate trough. So of course in these charts we're looking at an 80-day cycle. And here is our M shape. That's the first peak. Then this is the intermediate trough where the 40-day cycle trough would be. And then of course price rises to the second peak and then down to the final trough. So the D trade is a short trade as price falls from the first peak down through the FLD towards the intermediate trough. Now the D category trade is a trade which is unaffected by the proportionality of amplitude relative to the wavelength of the cycle, because as you can see here, the D trade on the right hand chart is also a very good trade, even though the cycles here are exhibiting correct proportionality. Now as you know, the markets mostly, I believe, tend to exhibit proportionality similar to the chart on the left, or at least closer to the chart on the left. In other words, their amplitude is not really proportional to their wavelength. But even if their amplitude is proportional to the wavelength, the D category trade is still a good and profitable trade. But as you can see from these diagrams, the D category trade usually fulfills its objective by moving down to the intermediate trough, and then it immediately bounces up again. Okay, so the D category trade is one that one needs to get out of fairly nimbly. I know I said that about the A category trade as well, but that's because the A category trade will often represent the uncertainty in a market that follows a trough. So there's a lot of uncertainty, and so people are, sort of dragging the market down a little bit after that trough. So sometimes one has to be nimble getting out of an A category trade, but one pretty much always has to be nimble or quick getting out of a D category trade. And most D category trades achieve their T2 target and then bounce straight back up again. And you've got to be very quick at considering getting into an E category trade. Of course, there are some D category trades which come down, and I'm going to draw over this chart on the right. They sort of come down, don't quite get above the FLD again, and then keep coming down again. So those are D category trades, which of course are very successful and very profitable. And there are, of course, D category trades that morph into F category trades. But I'm getting beyond myself here. Let's just speak about D category trades. Let's take a look at some D category trades in the market itself. Right, here is the example we've been looking at in the euro to US dollar. We have, of course, two full 80-day cycles, one of them there and one of them there. So we have two D category trades that we can look at, two examples, and the one is of course over here. As price came down from the first peak and came down to the 40-day cycle trough over here. So as you can see, that's a very good example of a D category trade. We'll look at it in detail in a moment. Our other D category trade occurred over here as price fell from the first peak, somewhere over there, down through the FLD and came down to the 40-day cycle trough over here. That is an example of not a very perfect or very clean D category trade, so we're going to look at that as well and see what we can learn from that example. D category trades exhibit, in my experience, less variety in their character than the other category trades. That is because of the fact that that they are in the particular position they are in the cycle shape. They're at the top of the M. So D category trades are sort of over there. And I find that there is less variety in that shape, whereas you get a lot of variety in A category trades and C category trades particularly. D category trades tend to exhibit less variety. That's just my experience. I'm sure as you start trading D category trades you will discover that for yourself, or perhaps you'll discover something different. Let's have a look in detail at these two trades. Okay, so the first thing to be said about D category trades is that they always use the standard FLD entry. In other words, we enter the trades as price crosses the 20-day FLD. Okay, standard entry always for the D category trades. We use the other entries, as you know, mostly for category C and category H trades. So D category trades use the standard entry. Here is a typical example of a really good D category trade. In fact, let me just go back a little bit. Let me just go back 10 bars or so that we can count the bars. The important thing with the D category trade is how many bars have elapsed at the point at which you enter the trade. So here you can see the day before we would have entered this trade, 28 bars had elapsed. So the price move downwards at this point is clearly a price move down into the 40-day cycle. Now, the average nominal length of the 40-day cycle is 34 days. So when you're sitting 28 days or 28 bars from a 20-week cycle trough or the 80-day cycle trough, you know that the market is due to turn down into its 40-day cycle trough. It's fairly obvious. You've got about 6 days to go to your average length 40-day cycle, and so it's fairly clear that that's what you're doing. Whereas there can often be some ambiguity surrounding the B interaction and the C interaction. Have you achieved your 20-day cycle trough yet or not? Has it passed us or is it still ahead? Often with the 40-day cycle trough there is less ambiguity. Simply because at this point the cycle shapes are beginning to emerge and they're becoming a little bit clearer. Let me demonstrate to you. You see here is a very clear first move up and then down into the 20-day cycle trough, and then there's your second move up. So it's fairly clear that what's happening at the moment is completing its M shape and moving down into the 40-day cycle trough. There's less ambiguity. I like D category trades because they are often fairly easy to identify. The big danger with D category trades, as I've already pointed out, is you've got to be very nimble getting out. And this is a perfect example. Here is the 20-day FLD, and the level at which price crossed it was in fact over there, which was slightly within the previous day's trading. So our entry point would have been just slightly below it. Okay, now the target that would have been generated by this trade is, as you can see from that peak there, through the crossing point down to about over here. So that's our T2 target. And what often happens with a typical D category trade is price will come down to that target, it will just touch it, okay, and then it will bounce up again, which is exactly what happened in this example. Let me zoom in a little bit and then we can see that more clearly. Okay, so here's our peak, and here is in fact our crossing point. And our entry price would have been slightly below that, of course, and so the target generated by price crossing there is round about here. Okay, that's your T2 target. And as soon as price had hit that target on this day, the 16th of, I can't see the month, but on this day here, price hit the T2 target and it immediately bounced straight back up again. Okay, this is a very typical D category trade. You will find your T1 and your T2 get hit very quickly, and you need to be very quick getting out. You do not ignore the rules for your trade 3. You don't get out just because your T2 has been hit, because sometimes, as I mentioned earlier, D category trades, you'll find price will bounce up, won't quite touch the FLD here, which is your entry for your E category trade, and will come down again, and your D category trade, your lottery trade, will end up carrying you into what turns out to be a very profitable F category trade. That is a situation that fairly often happens. So you don't ignore your rules, but I find that very often your trade 3 exits at a break-even level. So you make a profit out of trade 1 and trade 2, and your trade 3 exits at a break-even level. But you don't ignore your rules, because it only takes an occasional trade 3 to make a really good profit, to make it worthwhile following those rules. So don't ignore your rules. However, there is another slight sort of bending of the rule, which we're going to deal with in a little more detail in Module 5, but I need to introduce it here because it's an important aspect of trading D category trades. And that has to do with what happens when price almost reaches your T2 target. What do you do? Okay, so let's assume that in fact the T2 target for this trade was here. Let's just assume it was just a few ticks below the low of this day. Now, this is a little sort of I guess it's a rule of thumb, or perhaps you could call it a rule, but you only apply this in D category and E category trades. That's the first important thing. D category and E category trades, you only apply this rule that I'm about to explain to you. The reason you do that is because D category and E category trades have limited potential. If you look at the M shape of a cycle, there it is. Your D category trade has that limited potential. That's it. Your E category trade has that limited potential upwards. Okay, they are limited potential trades, whereas an A category trade, the target for an A category trade is about there, but it has the potential often to exceed that. Okay, same thing with an F category trade on the downside. It has the potential often to exceed that. Okay. So this is a rule that you apply to your D category and E category trades, and it has to do with when you have generated a target, such as I've indicated here, your T2 target, and price comes down and it looks like a perfect D category trade, but it misses that target by just a few points. What do you do? What I do, this is my rule of thumb, and you don't have to do this, but I recommend it. What I do is in a D category or E category trade, when a bar misses the target by just a few points, then in fact I set a tight stop. I either use some kind of a trend line, if I can find a trend line, okay, or I simply set the stop a few ticks above the high of the day, and I get out of that trade there. Okay, I hope you understand that. It's because a D category trade will often achieve its T2 target, and it will often achieve it with some accuracy. Okay, but our FLD might not be perfectly positioned. It might be off a little bit one side or the other. Okay, so our T2 target might not be perfectly calculated. So if the market very nearly gets to the T2 target, misses it by just a few points, and of course that's a subjective thing, but you'll get used to seeing it. It's going to be fairly obvious. Okay, if it gets very close to that target and then bounces fairly strongly, as has happened here with this D category trade, it came right down to very near the target, and then it bounced strongly. You see this green bar? It bounced really strongly upwards. That's a good indication that perhaps that trough has formed. If that trough has formed, then you would want to get out of this trade. Now, sometimes D category trades will do that to you. They will just miss your T2 target, and you'll get out. In this particular example, we would have got out at perhaps a tiny loss, or perhaps a sort of a break-even level if we'd set our exit just a few ticks above that day's high. So it's not the end of the world. We don't have a trade that turned into a big loser. But it is a rule that I apply to D category and E category trades, that if they almost meet their target and just don't quite do it, then you need to get out. So you set yourself a tight stop. We'll be looking at that in more detail in Module 5, and also applying the same rule to C category and H category trades as well. There's a slight modification that we apply to those, but it's something to bear in mind. Okay, so this particular trade, of course, did reach its target, and so this provides us with a perfect example of a D category trade. Okay, there is the FLD cross, pretty much exactly halfway through the move in terms of price, and D category trades are often like that. They just look very nice and symmetrical. Okay, but you've often got to be very, very quick getting out. Let's take a look at the other example of the D category trade in this series of two 80-day cycles that we've been looking at. Okay, here's the other example. Now, this is an example of a not very perfect D category trade, and in a moment I'm going to speak about why that is and why I've chosen these two cycles to demonstrate the character of the various trades. There's a very important feature of trading using the FLD trading strategy that's being revealed here by studying these two different cycles. Here is the most recent 80-day cycle trough. Okay, and here is the FLD. Now, as you know, we identified this as being a B category trade over here, and C was either the pull up there or the pull up here. It was one or other of those. So there's our C category trade. So we know that next, of course, is the D category trade. And here price touched that FLD on the Monday. Probably because of our Monday rules, we might not have entered at that level. We might have, but we might have entered slightly lower over here on the Tuesday. That's what I normally end up doing. And so our crossing point is at a level over here. And I've done too much drawing, I think, on this chart. So here is our peak. Here is our crossing point, probably at that level over there, or you might argue that it crossed there, but probably the correct crossing point is over there. And so the projection down from the peak through to the crossing point is in fact not very far at all. It's over here. And so that would be your T2 projection. It's a very small projection, and of course price exceeded our expectations on the way down. Now, this is, as I've mentioned, a D category trade. As soon as that happened, something very important would have occurred to you, or should have occurred to you. And again, this is something that we're going to be speaking about in detail in Module 5, but I need to introduce this concept here, because we're going to speak about it again when we consider the E category trade. We would have got into this D category trade, and we would have been surprised by the fact that the D category trade moved down a lot faster or further than was expected because of the crossing point of the FLD. So we'd be feeling good about this. We'd be making a profit in our D category trade. But straight away, this needs to occur to you that this is not a normal D category trade. I mentioned to you that D category trades tend to exhibit less variety in their character. Okay, so a more normal D category trade would have been from this peak over here down to this trough over here, or of course it might be that trough there, but let's talk about this trough here for the initial move. And so this would have been a normal or a conventional D category trade with the move down from that peak down to that trough there, if our crossing point had been about halfway through that level, which was over here. Okay, so if our crossing point had been lower, then this would have been a normal conventional D category trade. So this is a really important point. When we were in this D category trade, we would have looked at it and we would have said, you know what? That crossing point is out of place. Okay? We managed to get into the trade early because of where the FLD was, but with retrospect, I can see that the FLD was slightly displaced. Okay? How much displaced was it? It was displaced by about 3 or 4 bars. Let's say that's where we want our crossing point to be at that level there. That means that the FLD at that level should have occurred at this bar here. So it looks as if though the FLD is displaced to the left by 1, 2, 3, 4 bars. Do you see that? Okay, now I hope I'm not shaking the foundations of your understanding of the FLD trading strategy by talking about displacing the FLD. We're going to deal with this in detail in Module 5. There's a whole video just about this, about the FLD looks displaced, what do I do about it? So it's a very easy thing to do, and we only do it when we have trades that exhibit very consistent character, such as the D category or E category trades. And it only occurs at those times, so it's not something you need to worry about terribly the rest of the time. And what we do is we say, with retrospect, it looks as if though that FLD is about 4 days too far to the left. Okay, I hope that you see that. And we never move it more than about 3 or 4 days. That's another important point. It must never move more than 3 or 4 days. You never say, oh, it should be 10 days further to the left. You will only ever move it, usually by 1 or 2 bars, sometimes by 3, and occasionally by 4 bars. So you will actually move the FLD, if you like. Hypothetically, you will move the FLD. So I'm going to do that here because this is what you would have done if you were in this trade. Bear in mind that we entered the trade at the level of the FLD. Okay, so we're in a D category short trade, so we're in a profitable trade, so it hasn't affected our entry. But only with retrospect, after we got into the trade, were we able to say, actually, it looks to me as if though that FLD should be shifted over by 3 or 4 bars. So now let me try to draw that FLD, displaced 3 or 4 bars, or 4 bars in this case, to the right, and I'll show you what that FLD then looks like. Okay, I've tried doing it just roughly. You don't have to be absolutely accurate with this, but I have displaced that FLD. Can you see that? What I've done is I've taken the FLD and I've displaced it to the right. Okay. Now by doing that, I have generated a more correct crossing point here for our D category trade. Can you see there? So here's our peak. I keep drawing the peak over there because that is the slightly higher price, but in fact this peak would probably be just as good. And if you project through the displaced FLD and down to this side, then you get a T2 target over there, and that looks more like a D category trade. Do you see that? So we were in the D category trade, we were making profit out of it, but with retrospect, at sort of round about this bar over here, we would have said, wow, this has moved a lot further than we thought. Possibly I should displace that FLD. So we displace the FLD. You don't need to do it in Sentient Trader or anything. I sometimes draw on charts. I very often don't even bother drawing it. I just work it out. And so I say it looks as if though that FLD has been displaced. Now, of course, when we entered the trade, we would have worked out a T2 target way up here. So we have probably already exited from our trade 2. So we haven't done this in time to adjust our T2 target. Our D category trade at the moment would have exited T1 for a small profit, T2 for a profit, and we would still be in a profitable trade 3. So it's too late to adjust your T2 target. I'm not suggesting you do this to adjust your T2 target, but you do this in order to determine your entry into your next trade, your E category trade. So that's of course the subject of the next video. So in a moment we will be speaking about that, about entering your E category trade, and I'm going to be coming back to this, and I'm going to be saying, remember we displaced the FLD. So just make a note of that. So when you watch the E category video, I'm going to speak about displacing the FLD to determine your entry into the E category trade. So this is a very important thing that you should do. It does not affect your D category trade, except that once you've displaced the FLD, you would possibly not be using the FLD as an exit. Here's the FLD here. So you would possibly not be using the real FLD as an exit. You might use your displaced FLD. But in fact, what I find is that usually the 3-bar trailing stop takes you out before then anyway, which is the case here. So you would have exited anyway on the basis of your 3-bar trailing stop. So displacing the FLD does not make much difference to your D category trade, but it does inform what you're doing next, your E category trade. Now, I mentioned earlier that this trade is not a perfect example of a D category trade. In the first example, we saw a perfect example of a D category trade, whereas here we saw a very poor example of a D category trade, or not a poor example, but a slightly unusual example because our entry was so early. Okay, it was right up here. And when we were speaking about C category trades, this C category trade over here was a very difficult one. It was one that we couldn't get into. Now, why is that? There's something going on here. And I've kept quiet about it, but it's time for me to break the silence and explain to you what it is that's happening with these examples that I'm showing you. Let's zoom out again and let's have a look at our cycles. I started module 4 with a video where I said it's important to take a look at the longer cycles and see what's happening. And what's happening here is the effect of the longer cycles. Okay, and I mentioned that I'd chosen these two particular 80-day cycles. There's the first 80-day cycle, here's the second 80-day cycle. I chose them for a specific reason, and that is because there is a dominant 20-week cycle at play in the market at the moment. Can you see that? There's a 20-week cycle. If I asked you to draw the cycle shape on there, that's probably what you would draw, and that is the dominant cycle. So what's actually happening here is that our first 80-day cycle, this one here, number 1, our first 80-day cycle is on the upward slope, on the bullish slope of the dominant cycle. Okay, very important point. It's a very simple point to make, but it's a very important point. It's on the upward slope of the dominant cycle. Our second 80-day cycle over here is on the downward slope of the dominant cycle. Now, when that happens, it affects the categories of your trades. It affects your trades. Okay, it doesn't affect the categories. Sorry, it affects the characters of your trades. Okay, how does it affect the characters of your trades? First of all, when you are on the upward slope, on the bullish slope of your dominant cycle, what usually happens is you get very clear. I'm going to write it here. You get very clear trades. Okay, and in fact you might think that you get only very clear bullish trades, but I found that in fact you often get very clear bearish trades as well. I've just demonstrated to you this D category trade here, which was a very clear, very good D category short trade. So you tend to get very clear and obvious trades on the bullish side of your dominant cycle. Okay, so they tend to be very clear and as a result very reliable. So you can trade them without worrying too much, because the character of your trades is likely to be what I've described as your typical character of a particular trade. Now, on the downward slope of the dominant cycle, on the other hand, you tend to get rather blurred or unclear characters to your trades. We've already seen two of them. Our A category trade was fairly good. Our C category trade was very difficult to identify here. It could be there, it could be there. Our D category trade, although it turned out to be a very good, profitable trade, was a little blurred because the FLD was at the wrong level, if you like, or it happened very early. We got stopped into that trade really early. So on the downward slope of the dominant cycle, you tend to get slightly hazy, unclear, or blurred characters to your trades, and you will often find yourself saying, hang on, is this really a D category trade? It feels more to me like an F category. Could it be something different? As soon as you find yourself saying that about the trade that you're in, you need to ask yourself, where is the dominant cycle? Am I on the upward or the downward slope of my dominant cycle? Now, there's another important point to make about the downward slope of the dominant cycle, and that is that your bearish trades tend to be very profitable. I'll put a P there for profitable, and you can see in this example we struggled to get into our C category trade. Okay, our C category trade is of course a long trade. We struggled to get into it, and we probably wouldn't have. I wouldn't have worried too much about that because we were on the downward slope of our dominant cycle, so the fact we couldn't get into that long trade is not too much of a problem. However, we do definitely want to get into all our bearish trades on the downward slope of our dominant cycle. Now, I could write here that our bullish trades conversely are not profitable trades, but in fact I'm not going to, because that's not really true. Bullish trades, when you're on the downward slope of the dominant cycle, can still be good profitable trades. What you should bear in mind is that your bearish trades are going to bring you more profit. Your bullish trades should still bring you profit, and I will most of the time still enter a bullish trade on the downward slope. Sometimes I won't, but the only times that I won't is when it is clear that the market is very bearish. Then I will stay clear of it. The most usual thing that I do on the downward slope of a dominant cycle is I still enter a bullish trade, but I enter it with much less risk. So I will sometimes halve my position size. So I'm not going to write down that bullish trades are losing trades, because that's not true. Bullish trades can still be profitable trades, but they tend to be more tricky trades to get into, and you will just take a bit of profit before you get out. Okay, so that's a really important concept, the concept of where the dominant cycle is, and I thought this was an appropriate video to explain it, because it was really apparent in the D category trade. And what often happens when you're trading the markets is that you're not absolutely certain that you're on the upward or downward slope of a dominant cycle. You're sometimes not absolutely certain, but by the time you get to your D category trade, it usually becomes very apparent. And so when you see yourself in a D category trade like this one over here, where you got in very early, you're displacing your FLD, as soon as that happens, you should know that you're on the downward slope of your dominant cycle, and you adjust your thinking accordingly. Let's move on and take a look at our next category of trade, the E category trade.